Greetings, viewers at home. My name is Joel Jones Serrani, a lecturer at Ehlanzeni TVET College, Mapulaling campus. I'm teaching generic management. The subject where I'm going to teach you today is financial management level 4, topic 3, which is about interpreting basic financial statements. In interpreting basic financial statements, we are going to look at module 10, which is about analyzing elements of the balance sheet. In analyzing the elements of the balance sheet, we are going to look at the purpose of a balance sheet. What is the purpose of balance sheet? We normally do have balance sheet in our financial statements in the business. So we need to know what is actually the main purpose of doing this balance sheet. The purpose of doing balance sheet is to determine the financial position of the business within a financial period by comparing the assets, liabilities, and the equities of the business, which we apply what we call the accounting equation, which says assets are equal to the liabilities plus the equities. How often the balance sheet is required? A balance sheet is required depending on the size of the business. In large organization, balance sheet can be generated within a period of a month or a quarter of a year. But in a small business, the balance sheet is produced in a period of a year, which is annual. Classification of assets. We need to know first, what is an asset? Assets, we are talking about the belongings of the business. So when we classify the assets, we are going to classify them in terms of the fixed assets, and the current assets. So when we talk about the fixed assets, our fixed assets are assets that remain the same or remain in the business for a longer period. Fixed assets can include properties. It can include premises in your business, the business premises that you purchase as a business. It can also include the production equipments or production machinery and equipments. It can also include office equipment as well as vehicles that we use in the business. Non-current assets, we are talking about assets that are used in the business to produce a flow of product or a flow of product and sales, such as materials, debtors accounts, and bank accounts, as well as petty cash and many others. Those are the current assets that we can use in a short period of time. Classification of liabilities. Liabilities are classified as current liabilities and non-current liabilities or long-term liabilities. Current liabilities are liabilities that the business will have to deal with within 1 month or of the date of the balance sheet. This includes the creditors account and also bank overdraft, as well as short-term loans. The non-current liabilities or long-term liabilities are liabilities that are negotiated for payment over a longer period of or number of years. The example of this is the mortgage bond that you have. Some people used to buy bond houses that they pay for 20 years or more. So those are long-term liabilities. We also have owner's equities. Owner's equities, money invested in the business, is classified as a liability since it has been borrowed from the investor. That means the investors, when they invest in the business, they are classified as, that amount of money is classified as a liability. Of course, is an equity in the business, which we use to run a day-to-day business. Let us come to the analyzing of the balance sheet using the formula. Here are the formulas that we are going to use in order to do the interpretation and analyzing of the balance sheet. The formula to calculate the net worth of the business, which says the fixed assets plus the current assets less the current liabilities less the long-term liabilities, it gives us the net worth. We have the formula to calculate the return on investment, which is the profit before tax divided by the net worth or owner's equity multiplied by 100. In this case, we calculate our return in our investment. We also have the formula to calculate the stock usage, which we are going to check the performance in terms of the stock we have in our business. The formula says the stock plus work in progress divide by direct cost, we multiply by 365 days. We also have to calculate the ratio called the current ratio, whereby we are going to say the assets against the liabilities. The assets divide, it says the current assets divide by the current liabilities. We also have the other ratio called acid test ratio, which is also called the quick ratio, by calculating or comparing our current assets and our current liabilities. So in this case, the formula, it says the current assets less stock divided by current liabilities. Why do we call this acid test ratio, or we call it a quick ratio? Because we are going to say the current assets, we exclude the stock from this to check if the current assets without stock can be able to cover the liabilities. The last formula is to calculate the debtors payment ratio. In calculating the debtors payment ratio, the formula says the total debtors or average debtors divided by the sales or turnover multiplied by 365 days. Let us look at our information in our profit or summary of our profit or loss, or profit and loss for 2019-2020, and also the balance sheet for 2019 and 2020. We are going to use these two financial statements to analyze or to do the analysis of the this financial statement. Number one, let us start with the net wealth, the calculation of net wealth. As the net wealth, it says, according to the formula, it says the value of the total value of fixed assets. Let us go back to check how much is our total value of fixed assets. Let's look at our balance sheet. Our balance sheet, it says our fixed assets are for 2019. Our fixed assets in 2019 are equals to 86,500. They make 86,500, and then we say 86,500. The formula, it says total value of fixed assets plus the total value of current assets. That means we are going to check again in our balance sheet to see how much is our current assets. As you look at your balance sheet, the items that form our current assets, we have the stock and the work in progress, we have debtors, we have bank, and in total, we have to add them, all of them, and then we get the sum that will form the total value of our current assets, which is 195 when we add them. When we add our debtors, our stock, and the bank. So it gives us 195,415. Therefore, when we also go back to look at our formula, it says the fixed assets plus the current assets less the current liabilities. Let us look at our balance sheet to check how much is our current liabilities. Our current liabilities, we look at the creditors, which is the current liabilities. So the current liabilities is 64,500. So we say less 64,500, which is our current liabilities. And we also subtract the non-current liabilities, which happen to be long-term liabilities. So our long-term liabilities is 100,000. Our long-term liabilities is 100,000. For 2019, we have our current assets of 86,500 rand. We also have we add our current assets, which is 195,450, and then we subtract our current liabilities, which is 64,500, and then we have our long-term liabilities, which I made a mistake. It's supposed to be 100,000. Then the sum of all this, when we say this current fixed assets plus the current assets less the current liabilities, and we also less the non-current liabilities, we get the net worth of 782,585. This is our net worth for this business. So we also have to calculate the net worth of the business in 2020. In 2020, we are still going to apply the same principle we applied in 2019. We say current assets plus fixed assets less our current liabilities and less our non-current liabilities. How much is our current assets, our fixed assets in 2020? Our fixed assets is the same, which is 86,500, and then we say plus our our non-current assets, which is 191,667. Is 191,667 is our non-current, our current assets. Then we subtract our current liabilities, we less our current liabilities, which is 77,560, and then we also less our non-current liabilities, which is 90,000, Then we get the sum, which gives us our net worth. Our net worth to 100, it's gonna be 110,607. This is our net worth. So we have to compare these 2 years. As you can see, in 2019, our net worth is 782,000, and the following year is this. It means the business have dropped in terms of the performance. So let us go again and check the return on investment ratio. We are going to calculate our return on investment. In calculating our return on investment, it simply means when you have invested your money in a business, you have to also check how the investment increases or decreases, so that it means you are going to check what you are going to receive in your investment. So the formula to calculate the return on investment says the profit. The formula says the profit before tax. The profit before tax, we divide this by the net worth of the business. We divide it by the net worth or the equities, and then we multiply by 100. So let us go back to look at our information in the financial statements. We have a net profit before tax, or net profit before tax in 2019, which is how much? Is 111,915. 111,915 is our profit before tax in 2019. Therefore, we are going to divide it by our equities. How much is the equities for 2019? Our equities make 117,415 in 2019. 117,415. 415, and we multiply this by 100, and then it will give us 95,32 or 32%. 95,32%. And then in 2020, our net profit is 170. We have a net profit of 170,400. 170,400. We divide this by our net worth in 2000, or we divide it by our equities in the following year, which is 110,600, is 106,000, 110,000. Is it 110,607? Then we multiply this by 100. Then it gives us how much? It will give us 154%. It gives us 154,10%. It's 154,10%. And then when you check the information for 2019 and 2020, it simply tells that there is an increase in performance of the business in terms of the percentages, in terms of the return in investment, because it means the business have performed well in this case, because the percentage or the return on investment has increased from 95,32% to 154,10%. That means the business is performing well. However, we can also move on to do the current ratio, whereby we are going to compare the performance of a business in terms of the liabilities against the assets. In doing the current ratio, the formula says, the formula for calculating the current ratio, it says the current assets divided by the current liabilities. We divide by the current liabilities. So the current assets divided by the current liabilities. Let us look at our balance sheet. Let us take a look at our balance sheet. How much is our current assets for 2019? For 2019, how much is our current assets? Our current assets, we have 195,000 is 195,415. 415. How much is our current liabilities? Our current liabilities are the creditors, which is 64,500. It's 64,500. Then how much is our percentage? In percentage, it's gonna be 2.72%. It's time. Because we are calculating the assets against the liabilities. So it means our current assets or current liabilities, they go twice in our assets. So we also have to calculate to check our current ratio for 2020. In 2020, let us first check how much is our current assets. Our current assets in 2020 are 191,667. We take it against the liabilities, our liabilities in 2020, it's 77,560. 77,560, which give us the sum of 1.96 times. So it means in 2002, in 2019, our current ratio are more than the current ratio in 2020, which means our business is dropping in their assets, when we check the assets against the liabilities. Because in 2020, we have 1.96 times. That means the business is not performing well in terms of the assets, their assets against the liabilities. Remember, when we check, we compare the assets against the liabilities. The assets must always be more than the liabilities. That means that business have the assets covering the liabilities. Let us go further to the asset test ratio. The asset test ratio, this is another ratio. The asset test ratio, which says, the formula, it says, in 2000, let us look at the formula. It says the current assets, it says the current assets less the stock, our stock, and then we divide by our current liabilities. We divide by our current liabilities. In terms of this formula, let us go to look at our current assets. As indicated in our previous formula, it says in 2019, our current assets is 195,415. Then we are going to subtract our stock, which is the stock and work in progress, which give us the 44,000. It's 44,000. Then we are going to divide by our current liabilities, which is 64,500, which give us the sum of, or it give us it's gonna be 2.35 times in our assets. That means our liabilities will go to 35 or 35 times in our assets. That means the current assets can be able to cover the liabilities. Only the current assets without the stock can cover the liabilities in our business. So in 2020, the same happened. We have our current assets. Our current assets as given is 191,667, and then we are going to subtract our stock, which is how much the stock and work in progress. It's 76,167. 76,167 is this is our stock. Then we are going to divide by our current liabilities, in order to get our acid test ratio. So our current liabilities is 77,560, which is giving us the answer will be 1,09 times in our liabilities. So it means when we compare, we check our acid test ratio for 2019 and the acid test ratio for 2020, it shows that there is a decrease. It means there is a decrease. That means the business is not performing well in terms of comparing the liabilities and the assets. The business have dropped. So let's come to the formula to calculate our debtors payment ratio. The formula to calculate our debtors payment ratio says the average debtors or total debtors divided by our turnover multiplied by 365 days. Okay, let us go to check in 2019. In 2019, how much is our debtors? Our debtors in 2019 is 46,000. It's 46,000. Then we divide it by our turnover, which is 509,600. Is it 600? 509,600. And then we multiply by 365 days, which give us the sum of 33 days. It means 33 days in 2019. In 2020, let us apply the same principle. How much is our debtors in 2020? Our debtors is 63,500. So we say 63,500. We divide it by our turnover, which is 772,000. Our turnover is 752,000. I mean to say, it's 752,000. We multiply by 365 days. Then it gives us 31 days. It gives us 31 days. Then when we look at this analysis, this information or data, it tells us that it means the business is doing well in terms of collecting the debts from its debtors, because all debtors are managed, they are managing to pay their debts within 31 days, within the cycle of 30 days. So it shows that the business is performing well in terms of debt collection. This, ladies and gentlemen, mark the end of my presentation for today. And if you want to find more details or more information, you can follow us in our website www.ehlanzenicollege.co.za, and Facebook. You can get us at Ehlanzeni TVET College. You can get us at Twitter at Ehlanzeni TVET, and you can also get us on YouTube at Ehlanzeni TVET College. Thank you.